Hi, this is Karen Gaines, your nonprofit finance guide, and today we are going to talk about the difference between revenue and cash. So one day I had a client give me a call, and when I answered, he immediately went into, hey, I received your financial statements, and I think these financial statements are wrong. There is no way these financials are right. I have worked really hard. I have a ton of revenue, which is listed in the financial statements that you just sent me. However, my cash is very low. So there has to be some type of mistake, some type of error. So we went over his financial statements. And what we found was that his accounts receivable balance was very large, which means he had been working very hard to earn the revenue. However, he had not been collecting the cash that he earned. So he understood and started thinking about ways to collect on his accounts receivable, collect the cash that he had worked so hard for. I've heard other people have the same type of scenario. Hey, this don't make sense. I produced a lot of revenue. Where's my cash at? And there are a lot of individuals who have mistaken revenue for cash. So I'm going to go over the main differences between the two. This conversation is especially important for organizations who operate on an accrual basis of accounting. This means revenue is recognized when earned. Cash basis accounting recognizes revenue when cash is received. A lot of organizations, especially the larger ones, operate on an accrual basis of accounting. So revenue is money earned for providing products and or services to customers and clients. So let's say you provide a service and that service generated revenue of $10,000. You provided $10,000 of service to a client, and the client does not pay you $10,000, at least not immediately. But that $10,000 would go into your financial statements as revenue. Okay, so let's say that same client, a few weeks later, they pay you $1,000 in cash. Well, that cash will go into the cash account. It's not revenue, it's cash. And so your cash would increase and your accounts receivable would decrease. Okay, now if you were operating on an accrual basis of accounting, on a cash basis of accounting, and you provided services of $10,000, that $10,000 would not go on your financial statements. Okay, you would just have to kind of keep a note of the fact that you provided $10,000 worth of services. Now, let's say, the same client, a few weeks later, they gave you $1,000 for the services that you provided. That $1,000 would then be recognized as revenue. And of course, the $1,000 would be deposited in the cash. So your revenue would increase by $1,000 and your cash would increase by $1,000. Okay, so that's those two demonstrations or those two examples I just talked about is an example of revenue when using the accrual basis of accounting, and revenue when using the cash basis of accounting. Okay. So here are just some more differences between revenue and cash. So as we just talked about, revenue is recorded in the books when services are delivered, and cash is recorded when those services are paid for. Revenue measures the effectiveness of generating sales, while cash measures how much of those sales turned into paid services. Revenues can be reversed or written off if the customer, the client, refuses to pay for services. Cash is not affected if a customer never pays for services, because when you rendered services, you never put that the money earned on your financial statement. So nothing is really affected when the customer chooses not to pay. Revenue can be overstated. Oftentimes, when revenue gets overstated, it's because the company, the organization is trying to meet some type of metric or budget or some type of a number. Now, when using cash, it's difficult to manipulate cash, as it should always agree with the bank account at any given point in time. Revenue is found on the profit and loss statement, and the amount reflected is for a period of time, such as revenue earned for a period of 1 month or revenue earned for a period of 1 year. Cash is found on the balance sheet and is reflected at a certain point in time. A cash balance at June 30th or your cash balance at October 31st. So it's a balance as of a certain date. Cash inflows does not necessarily mean revenue was earned. It can mean a loan was received, dividend or interest was earned, a gift or donation was made. It can mean a variety of things, but cash inflows does not always mean revenue was received. If you're facing a situation in which you have a lot of revenue but low cash, like in the example I just gave, this could be an indication that you are not collecting on the revenue you earn. You may have high accounts receivable balance, and efforts must be made to collect on the receivables. If you have a situation in which you have a lot of cash but low revenue, this could indicate you have a lot of cash in your reserve account, or it could mean you have a lot of loans and debts that you've received. In either case, an effort should be made to generate cash from revenue and or donations to sustain growth of the organization. While revenue and cash are not the same, they are intertwined. Oftentimes, one affects the other. A healthy organization generates revenue and collects cash on the revenue earned in order to sustain operations and grow the organization. So I hope this video was helpful for you. Let me know your thoughts on this video. If you're watching via YouTube, make sure you like, comment, and subscribe. Thank you for watching and have a great day.